Good evening and welcome to another video by the bottom line. Uh, what a day in Nifty in terms of the range. It's covered close to 500 points from the open to high back to the close. So this is exactly what happens at all-time highs. You cannot really predict which way the market is going to turn, and again the valuations do not seem to be a problem, but imagine someone looking at markets rising higher and investing on this candle. They are immediately in a portfolio at a portfolio level, they're immediately down by close to 5%. If the stock selection is not appropriate, then they could be close to 10% down on their portfolio. So that's one thing that is very important when you look at the time and place of investment. In today's video, I want to cover, we constantly talk about which stocks to select, or I constantly talk about how I select stocks, but very rarely we speak about how I reject investment ideas. And a rejection can be on multiple aspects. It's not just one point that I reject on, but I've tried to put together a few examples of on what basis I reject stocks, with a few real-time examples that I could sense in terms of the problematic situations in those stocks. So the first example is Intense Technologies. Now, if we look at it, it's a strong company in all terms. The valuations are fantastic as compared to the industry, so we're good there. If we look at the OPMs, they are significant. Even on a yearly basis, the OPMs are good. If we look at the borrowings, there are no borrowings, so it fits all the business ideas that are important. The debt to equity is significantly comfortable. Now the problem area is the cash flows. So if we look at cash from operating activity and the cash from investing activity, and the difference between these two, which basically is free cash flow that remains with the company after everything is done, we see significant years in between 2015, 2016, 12 and 2003, where we are seeing significant problems in free cash flows even 2018. And when I try to look at what has actually gone wrong, is there have been problems in the receivables of the company, right? So the money or the cash that is required after they have provided the services are not coming on time, and that creates a liquidity crunch. So if there is a problematic situation in the economy, then these are the first few players that get hit real bad because of the lack of cash. So this makes that first example, because of the lack of free cash flow, to reject an idea. Second is the Satya Industries, which I had in my list, but the basis of rejecting this idea was very, very simple. That actually, if you see the stock P is 5.74, industries at 6.22, there is a significant gap in the two. If you look at everything about their financials, it's fantastic. Look at OPMs, increasing sales, cash flows, everything is brilliant. But the most important point that where I get stuck on this stock is the debt to equity ratio. And anything less than 0.5 is what I'm comfortable with. I generally go for everything that is below 0.25 as well. So 0.5 puts me in a lot of discomfort, because we are already in a high interest scenario, and I do not want to bet on such a stock. Even if this tomorrow goes to 400, I don't care, because this just does not fit the investment idea and the portfolio building that I do in my way. So this is one of the other reasons that I reject a particular investment idea. Now, the third reason is very subjective to each one of us, which is ethics. Generally, I do not invest in companies that are related to pharmaceuticals, a lot of reliance on healthcare, or if they are promoting uh, any product that is, it's not beneficial for the society in as a whole, right? One of such company is GM Breweries. Now, if you look at the GM Breweries, it's basically a company that simply makes country liquor, which it's a very big organization. If you look at it, the stock P is fantastic at 12, well below the industry P. No debt. It's fully funded capital. If you look at the stock, it's quite significantly lower from where it was at its high. So it's a good point for me to buy. If you look at the OPMs, surprisingly the OPMs are fantastic, well below 20, well about 20. If you look at the cash flows are good. Every time you see a heavy value like this, which is very close to the operating cash flow, you look at what has happened inside the cash flow. So 101 is investment purchase, 73 is investment purchase. So actually, if you look at it, it's 90 crores, and here close to 40 or 50 crores, that is free cash flow. ROC is also good. Now, because of the only aspect of it being a company that makes country liquor, and the most important product that they have is all these, which is GM Santra, GM Doctor, GM Limbu Punch, and this company basically creates alcohols that are not beneficial for anyone. So I don't like to promote or fund such organizations with public money. So that's another criteria to to reject a stock idea. So basically we saw three: one, where the free cash flows are negative; second, the debt to equity is well above 0.5 or even is at 0.5. Again, 0.5 is not a golden number, but that's something that I like to follow, because it has given me good results when I have bought organizations which are low in debt and high in equity, right? And the third one is obviously ethics. Again, it's a very subjective aspect. If someone likes to invest in such a company, there is no comment on any business, but it's just my way of isolating myself from making such investments, right? So that's about it. That's all I had to cover today. I hope this was insightful. I'll see you in the next one, and until then, good luck and good investing. Bye bye.